So I'm not so sure it's. I actually don't think it's sort of disruptive to the PE model. I think it's much more disruptive to the IPO model. It's almost like a combination of a private deal and an IPO. That's really how I think about SPACs. Ultimately, the companies that that are going to end up merging with these SPACs. Well, let me take a step back and just make sure the audience understands what a SPAC is. So a SPAC is a special purpose acquisition company. That's what SPAC stands for. The sponsor, whether it's a PE firm or an individual, raises capital from public investors. And then it uses that capital to buy all or part of a company. And basically that company instantly becomes public instead of going through the normal IPO channels. And so from that company's perspective is really the interesting way to think about it. So there's only certain companies out there that want to go public. You're not going to take a lower middle market private equity acquisition target and merge it into a SPAC. They're not big enough. They may not have a sophisticated enough management team. They may not have enough growth. They might not be sort of interesting enough of a story. So it really only applies to those companies that might have considered going public to begin with. And so from those companies' perspectives, why would I use a SPAC to go public versus going the traditional IPO route? It's really a matter of expediency and execution, and then also the ability to potentially partner with a sponsor in the effort, which in a normal IPO context, you don't really do that. You might put interesting people on your board of directors, but you don't really have a traditional deal maker sponsor sitting at the table with you, which might be an attractive feature for some companies. So from the company standpoint, instead of having to write all these complicated SEC documents, file an S1, go on these complicated road shows, take a lot of risk from a pricing standpoint, you have this vehicle that's already set up, already has, can put a valuation on you. It's actually a relatively straightforward transaction and it's much lower cost. The offset to that is you end up giving economics to the sponsor. So the lower cost of the actual going public is sort of offset almost entirely by the economics you give away. So, bottom line is I view it as an alternative method for companies to go public in a faster way and in a way where you can, gain access to potentially an interesting partner. Now, why are private equity firms doing it? The answer to that is it's capital. You could go raise a fund and manage that fund and make money on the fees and the performance incentives on the fund, or you can do the same thing with a SPAC. So it's just another pool of capital. And so, private equity folks are economic animals and they're going after where the money is. That's plain and simple why it's happening right now. That's why we chose to do it. It's a distraction from our normal private equity activities, but it's a good distraction because it's an opportunity to do a really interesting transaction. And then I guess the reason that investors are interested in it, they're the third party in the equation here, is because SPACs right now can actually be really attractive relative to the alternatives because of what's going on with COVID. The roadshow process is challenging. Getting a deal done is challenging. So you have these vehicles set up that allow somebody to go public without the normal headache and procedures. And so there is some attractive features of that as well.